This video will walk you through the important concepts presented in Chapter 8. Chapter 8 focuses on profit planning and the master budget. What you see on the screen right now is a diagram that shows all the individual budgets that make up the master budget. The budgets that are in bluish color are what we call the operating budgets. And then the budgets that are in the orange boxes are what we call the financial budgets. The diagram also shows you the order of preparation of each of the budgets. The first budget to be prepared is the sales budget. Everything is driven by the sales budget. So all parts of the master budget are dependent on what sales says. Once we know what we're projected in sales, then we can figure out how many units we need to produce. Then we can figure out the cost of those units, namely the direct materials, direct labor, and manufacturing overhead. And then we can, once we have the operating components, we can then prepare our cash budget, budgeted income statement, and budgeted balance sheet. The other operating budget that's not shown here is our capital budget. And that's part of Chapter 13. So let's take a look at some of these budgets. So when we look at the sales budget, the budgets that we're preparing this year are for the year ended December 31st, 2012. And you can see that the budget has been prepared in quarters. So we're projecting quarter one that we plan on selling $200,000 worth of revenue. That's going to be 10,000 cases at $20 a case, or a total of $2,000 of revenue. The second half, or the lower half of the sales budget, is the schedule of expected cash collections. What that is going to show us is that it takes 2 quarters. The first quarter of sales, we collect 70%. The second quarter, we'll collect the remaining 30%. Now what's not shown in here is if we're collecting 100%. If it was less than 100%, these two percentages, when we add it together, there would be bad debt expense. So let me say that again. If our percentages of collection, when we add it up, is less than 100%, that would mean we have some bad debt, meaning we're not going to collect all of our sales revenue. That's on credit. So if we take a look at this, if we are projecting $200,000 in sales, and we collect 70% of that, 70% of $200,000 is $140,000. The remaining 30% times $200,000, $60,000, will be collected in the second quarter. And you can see here it totals to the full $200,000. Because we're projecting, based on historical information, that we collect 100% of credit sales. Pretty unrealistic, but this is what it is. If it's less than 100%, we would have some bad debt in there. Now the other thing we want to look at is this 90,000 here. What does that represent? Well, it says accounts receivable beginning balance. Now remember, we're doing for the year 2012. So this beginning balance comes from 2011's, December 2011's ending balances. So we look at the textbook here. This truly is December 31st, 2011 balance sheet. And you can see accounts receivable, 90,000. So that 90,000 is what's remaining of the fourth quarter sales done in 2011 and what has not been collected yet. So that's going to be the 30% that's going to be collected in the following quarter, which would happen to be the first quarter of our current year, 2012. So that's where that 90,000 is coming from. Then if we look at second quarter here, we're projecting 600,000 in total sales. If we collect 70% in the same quarter, 7 times 6, 42, or 420,000. Then the remaining 30% times 600,000 is 180,000. So again, you can see it takes 2 quarters to collect all of our credit sales. Now, once we know how many units that we're projecting that we're going to sell, so we're selling, these are cases, happens to be cases, that information flows into the next budget, which is the production budget. So that same information from the sales budget flows into the production budget. So now what we want to figure out is how many units are we going to produce? Some people will say, well, in quarter one I need to sell 10,000 units. I'm going to produce 10,000 units. Well, we want to have some units on hand so that if we have more sales than we project, we have the units on sale, on hand. And if we want to have units on hand, which is what we call our desired ending inventory, we also want to have, or what it means we'll have, is beginning inventory. So again, we want to sell 10,000 cases. So for sure we know we want to produce 10,000 cases in quarter one. Well, we also want to have so much inventory left. So it's like a starting point for next quarter. So we want 6,000. And what that is based on information that we're given, and that's coming from production managers and historical information of what we want to have just in case there is peaks and valleys of customer needs. It says we want 20% of next quarter's sales as the desired ending inventory. So the 6,000 is 20% of 30,000. This 8,000 is 20% of the 40,000. And this 4,000 is 20% of 20,000. And this 3,000, we would have been told what is next month's or next quarter's sales for 2013, and we would have gotten the 3,000. So again, this 20% will be given to you. It's not something you have to calculate. That is based on historical information that a company has. If they are a new company, they would use industry standards for an industry that is similar to what they're producing. So when you add the 10,000 and the 6,000, we're left with total needs of 16,000. But because we are trying to have ending inventory on hand, that means we must have beginning inventory left from last quarter or last quarter's ending. So this 2,000 here is what's our beginning inventory or last quarter's ending. Well, where does that 2,000 come from? You can see with the arrows for quarter twos, the beginning inventory is last quarter's or quarter one's ending inventory. Quarter three's 8,000 comes from last quarter, quarter two's ending inventory. So where does this 2,000 come from? Well, one of two things. They can either just tell you that you had ending inventory for December 2011 of 2,000, or you can actually get it from the information here. If 20% is what we used last year for our desired ending, well, think about it. What would quarter four desired ending inventory equal? Well, it's going to be 20% of quarter one's sales. So that's going to be 20% quarter one sales. Because again, if we're looking at quarter four here for prior year, just like the 6,000 came from looking at next quarter sales, 30,000 cases times 20%, quarter four of the previous year would have looked at the next quarter, quarter one for 2012, and taken 20% of that. So you don't, long as the prior year used the same desired percentage, you don't even have to be given prior information. You can just take what is my current sales projected in this quarter, times it by the percentage I want for desired ending, and that's the current quarter's beginning inventory. So you may want to repeat what I just said. So again, this is a really huge clue sometimes for questions that you're asked on exams. If they don't give you the ending information for last quarter, you don't need it. You've got the ability just to say, okay, how would fourth quarter calculated as desired ending? It would be looking at quarter one's 10,000 units times 20%. And then that 2,000 would be quarter four's ending, which becomes quarter one's beginning. So then we take that 2,000, that's the beginning inventory we had available, subtract it from the 16,000, and that says we need truly to produce 14,000 cases in quarter 1. And the same thinking is for quarter 2, 3, and 4. Now again, I want to show you what you have available to you for the exam is the formula sheet. And what we've done on the formula sheet is giving you the outline of the production budget here. Budgeted sales plus desired ending inventory of finished goods equals what I totally need less what I already have produced, which is beginning inventory or last period's ending desired. Subtract that and I'm going to get required production. So we've given you the outline on the formula sheet of the production budget. Once I know what I need to produce, 14,000 cases in quarter 1, 32,000, so on, we can then now start pricing it. What is it going to cost us to produce those? So that's our product cost. So the first product cost we have is direct materials. And you can see here that this just comes right from the production budget. The 14,000, 32,000, 36,000, 19,000, and again we've got the total for the year. So the first part is just to bring in from production what do we need to produce, that's units. Then we're going to multiply it by what is the quantity of the raw materials we need per case. Well, it takes 15 pounds per case. So therefore my total raw materials, my total pounds, and I'm just going to remind you that that's pounds, is 210,000. 14,000 cases times 15 pounds per case. So I need a total of 210,000 just for what I want to produce. And just like production, we want to have some ending raw materials in excess of what we plan on producing. And so here it's telling us that we are going to use historically 10% of next quarter's needs in having a desired ending raw materials. So let me uncircle this so you can see the number behind it. So in quarter 2, we plan on producing 32,000 cases times 15 pounds per case, or we're going to need 480,000 pounds. Well, that 480,000 pounds I'm going to multiply by 10%, and that's going to give me my first quarter's desired ending raw materials. Do the same thing for quarter 2. You're going to take the total pounds needed in quarter 3 times 10%, and you're going to get 54,000, and so on. So then you add the 210, what I need in pounds for current production needs, plus what I want to have left over for desired ending, and that gives me my 258,000 pounds, less what is my beginning pounds. And we're going to do the exact same thing here. This beginning number, 21,000, we're going to get that by taking my raw materials needed for production for quarter 1, 210,000. So I'm going to put a little asterisk here, and that's by taking 210,000 times our 10% need, just like we did in production. Because again, if I had done last year's quarter 4, its desired ending would be 10% of the 210. So that's 21,000, and that 21,000, my desired ending for quarter 4 in 2011 becomes quarter 1's beginning balance. We subtract that beginning balance from the 258, and that says we need to purchase in quarter 1 237,000 pounds. Again, pounds so far. We haven't gotten to the actual cost yet. And then we're told it's 20 cents per pound, which means then it's going to cost us $47,400 to purchase 237,000 pounds. Now, just like in sales, once I knew the total amount of sales, I then had to do a schedule of cash collections. Well, for materials, I buy my materials using accounts payable, using debt. So I've got to figure out, on the flip side here, my schedule of cash disbursements. And we're told that we pay 50% of our purchases in the quarter we make the purchase, and the remaining 50% in the following quarter. So we have $47,400 here in accounts payable purchases. If we pay 50% of that, that'll be $23,700 in this quarter. The remaining balance to be paid next quarter. So just like in accounts receivable, we have accounts payable beginning balance, $25,800. Again, if we go to our 2011 balance sheet, we can see accounts payable down here under liabilities, $25,800. That is the 50% of the purchases that were made in December 2011, or I'm sorry, the fourth quarter of 2011, and that's the ending balance of December 31st, 2011. So that 50% we will pay in the first quarter here to pay off last year's fourth quarter purchases. So, some common questions that you could be asked both on the schedule of cash disbursements or the schedule of cash collections. So I'm going to go back first to the schedule of cash collections. At any time, I can ask you, what is the account receivable ending balance? So, for example, sorry about this. Sometimes the tablet has a mind of its own. So if I was to ask you, what is the account receivable ending balance, EB, for December 31st, 2012? Well, we go to our sales for last quarter. It's $400,000. So we know that we're going to collect 70% of that, 7.7 times 400,000. We're going to collect 280,000 in the fourth quarter. What's not going to be collected this year is the 30%. So 30% times 400,000. So 400,000 in sales times 30%. That's 120,000. So if we take you to the balance sheet, accounts receivable, 120,000. And again, that's taking the 400,000 fourth quarter sales times 30%. And you can do that for any quarter. You just look and see what is our schedule of cash collection percentages, how much will we have collected. So for example, if I asked you how much is left to be collected at the end of the third quarter, well, it's 800,000. We collected 70% of that. What's still remaining to be collected is 30%. So we would collect 30% times 800,000, or 240,000. And you can see there's the 240,000 right there. So that 240,000, if I put a little a here, equals my, that would be September 30th, 2012 accounts receivable ending balance. That's what's left to be collected, because the fourth quarter hasn't happened yet. So all's at the end of September 30th, all that's remaining to be collected is 30% of the 800,000. Now, if it takes more than 2 months, then you would have to take the percentages times the current quarter's collections. Also, you might have to go backwards. For example, if it takes 3 months to collect, then you'd look at quarter 2 and say, okay, by the end of the third quarter, I would have collected whatever percentage I collect in the month that I make the sale, whatever percentage I collect in the month or the quarter after the sale, but I would not have collected the third percentage. So, for example, if I say it takes, let's say 60% in the quarter, and then I say it takes 20% in the second quarter following the sales, and then the last 20% is collected in the third quarter. For any sales made in the second quarter, I don't finish collecting it until the fourth quarter. Then we can do the same thing for accounts payable. If I want to know what is my December 31st, 2012 accounts payable ending balance, well, I look at my fourth quarter here. I have credit purchases of $55,800. I know I pay 50% of that in the current quarter. So that means 50% of $55,800 is $27,900. You can see that right here. So what's remaining is the other 50%. So 55,800 times 50% says I will have accounts payable ending balance of 27,900. And again, if I go to my balance sheet for December 2012, oops, sorry about that. There's my 27,900. And again, that's represented by taking the 55,800 fourth quarter direct material credit purchases times 50%. So we've done one product cost of manufacturing costs. What you want to remember is manufacturing cost is made up of, I'm just going to put it over here for you guys, manufacturing cost or product cost is equal to direct materials plus direct labor plus your manufacturing overhead. So we've taken care of direct material pricing the production units and putting a direct material cost to it. Now we need to put a direct labor and a manufacturing overhead cost to it. So again, we start off with our production budget and how many cases we plan on producing, same numbers. In our information, we're told it takes 0.4 hours per case. So we just multiply 14,000 cases times 0.4 per case, and that says we need total for quarter one 5,600 hours. Then we want to remember, we want to price this. So we want to say, what is our cost per hour? Well, we're told it's $15 per direct labor hour. Multiply that, and we get a total direct labor cost of $84,000. So then we want to price our overhead. Now, what you want to remember from when we've been from previous chapters where you learned how to apply overhead. Overhead is applied during the year, and it's applied on some sort of base. And the base is going to be, for here, direct labor hours. So budgeted direct labor hours. It's coming right off of the direct labor schedule, which if I can go right here, it's coming right from here. How many direct labor hours does it take to produce the number of cases we want? Then overhead is made up of variable and fixed. The variable portion is always a cost per unit. So we're told that the rate is $4 per unit. So we multiply that out, and that says the variable cost is $22,400. Then we have fixed cost. And remember, fixed cost we deal with in total dollars. So this is total dollars versus our variable is going to be a cost per unit. So variable is cost per unit, fixed cost is total dollars. Now remember, manufacturing fixed cost is made up of a lot of different types of costs. It could be rent expense, it could be mortgage, it could be depreciation, utilities, maintenance, supervisor salaries. But it does have depreciation, and depreciation is a non-cash transaction. So let me say that again. Depreciation, let me I think I've got some room down here. So depreciation expense is a non-cash transaction or expense. And why is that? Well, the cash is involved when you make the purchase. When you purchase equipment, the journal entry is going to be to debit equipment, and that little arrow means credit my cash or my note payable. So that's where the cash comes into play. When we do depreciation expense journal entry, you debit depreciation expense and you credit accumulated depreciation. There is no cash being debited or credited. So in preparation of the cash budget, you always want to back out depreciation, which is what this line's doing. We're going to back out depreciation so that we're left with a line, cash disbursements, and that truly says of all the expenses that are manufacturing, what are cash expenses. So total manufacturing overhead, variable and fixed, is $83,000 for quarter one. But when you back out depreciation, the cash expenses that represent manufacturing overhead for quarter one is $68,000. And this is what's going to go to the cash budget. So again, this line goes to your cash budget. And we can see that. You can see it's 68 for quarter one, 96,800. So let me just scroll down here quickly to my cash budget. And then if you look at manufacturing overhead here, there's the 68, the 96,800, 103,200, 76,000. Because the cash budget only deals with cash revenues and cash expenses. It is not, cash budgets are not created on accrual accounting. So we've come up with our 3 product costs or manufacturing costs. The last thing we want to do is figure out what's my cost per unit for manufacturing. So we're going to take my total expenses for manufacturing overhead of $404,000. We're going to divide it by the total number of hours, 40,400, and therefore we're going to get $10. $10 per direct labor hour. So you can see your overhead is $10 per direct labor hour. Your direct labor, we know, is 40 cents per case. And we know our direct material cost is 20 cents per pound. And so we can figure out, if we know it takes 15 pounds per case, 15 pounds times 20 cents will give you 15 pounds times 20 cents will give you the cost per case. And that's what this is doing here. I'm just showing you the finished goods schedule just because it brings in the total cost of the product. Namely, the direct materials takes 15 pounds times 20 cents. There's the $3. Direct labor, it's 40.4 hours per case. We pay $15 per hour. So that's going to be $6 per case. And the manufacturing overhead, it takes 40.4 hours to produce, and we pay $10 per hour. So you add it up, that says your total product cost is $13 per case. And then if we know that we have 3,000 in ending finished goods at $13, we know our ending inventory that's going to go on the balance sheet is $39,000. So let me say that again. If we know our ending inventory, and that's going back up to our units here for production, there's my ending balance, 3,000 units. I need to price that so I can put it on my balance sheet. So we take that 3,000 units, from the production budget, which is why it's saying Schedule 2, times it by the total cost. Again, this is the total cost, product cost. Product cost per unit. That tells me on my balance sheet I'm going to have ending inventory of $39,000. And again, if I scroll down to my balance sheet, finished goods inventory, 39,000. The material 4,500 comes from my raw materials budget. If I go to my raw materials budget, we look and see that, again, we're talking about raw materials. What's my ending balance here? 22,500 times 20 cents. When you multiply those two out, you get the 4,500 that's on the balance sheet. Okay, administrative, or what we call period cost. Another word we call it is operating expenses. Has a variable component. For the 10,000 cases, it's costing us, again, a cost per unit for variable cost, $1.80. So variable cost is going to be 18,000. Then we show all of our fixed selling and administrative expenses. But you can see we've got depreciation here. So just like the overhead budget, we want to have a line that just says, what's my cash disbursements? So I'm going to back out, just like we did under the manufacturing budget, I'm going to back out my depreciation here. And so the cash disbursement, 107,000, that's what's going to flow to the cash budget. So again, you can see it says Schedule 7, which is the selling administrative budget. This is excluding, again, depreciation because it's not a cash expense. Okay. Then going to the cash budget, you have a beginning balance. Sorry. Beginning balance that is coming from December 31st, 2011. We can see that if I go back to the books and see the 2011 balance sheet, 42,500. My cash collections is going to come from my cash collection schedule, which is the lower half of my sales budget. So I have totally available 272,500. I'm going to subtract all of my disbursements, my materials, labor, overhead, selling and administrative. We also are told that we're going to purchase equipment. So we put the equipment purchases in there. We also are told we're going to pay dividends every quarter. When you add up all the cash expenses, it totals 366,500, way bigger than our total cash collections. So we have a deficit of 94,000. So if we want to have a minimum, so if we're told that we have a desired minimum cash balance equal to 30,000, and we borrow in increments of 10,000, that's going to tell us, well, if we have a deficiency of 94,000 that I got to cover, and I want a minimum cash balance of 30,000, that says I need 124,000, but I have to borrow in increments of 10,000. So that's going to mean I've got to borrow a total of 130,000. So that's where the 130,000 comes from. 94,000 to cover the deficit, 30,000 to cover my minimum cash requirement. At a minimum, I would need 124,000, but since I have to borrow in increments of 10,000, I have to borrow full 130,000. And you do the same things for quarters 2, 3, and 4. And then the last thing, you can see we have an ending balance at the end of the fourth quarter of 41,400. That's going to be the ending balance that flows into my year-end balance sheet. 41,400. Now the other thing to remember about the cash budget is we've got the cash collection section, you've got the cash disbursement section, excess and deficiencies, and then finally the financing section. And what you want to remember here is that on the financing section, borrowings are at the beginning of the quarter, repayments are at the end of the year, which is why you see repayments here at the year end. And that's going to be based on your agreements with your bank. And then interest is paid also at the year end when you pay back your borrowings. Then we have the income statement. Income statement has the sales coming from the sales budget, the cost of goods sold, which is going to be my product cost. So this is my product cost here. And where this is coming from, if we go back to the sales budget, we're going to have a total of 100,000 cases. Remember from my finished goods section, it cost us $13 per case. So 100,000 cases at $13 per case, 100 cases times $13 per case, which is coming from my finished goods schedule, is where we get the 1,300,000 for cost of goods. And then everything else I think is self-explanatory. Interest expense is coming from the cash budget. Selling administrative, of course, is coming from the selling administrative expenses. Now, the other thing to remind you on this is that the income statement budget includes depreciation expense. Okay, because income statement is accrual based, not cash based. Okay, so again, the income statement budget includes depreciation expense. And then finally, you would finish out your, tablet has, like I said, a mind of its own sometimes. You would finish out your balance sheet. We didn't make any additional purchases of land. What we are doing here with the building and equipment, we had $700,000 beginning balance, and I can see that right from my balance sheet here, $700,000. That's my 2011 balance sheet. And if I go back to my cash budget, I purchased $130,000 in equipment. Which gives me the total of $830,000. Accumulated depreciation, you'd be given information so that you'd add whatever you depreciated this year to prior years' accumulated depreciation. We already know where we get the accounts payable balance from. Common stock, there was no change, and then retained earnings is just taking beginning retained earnings plus net income minus dividends, which gives you your ending retained earnings. So that, in a nutshell, is how all the budgets are interrelated to each other.